Today, we're diving into the latest earnings report from Altria Group, the tobacco giant behind brands like Marlboro and Copenhagen, which responsibly leads adult smokers to a smoke-free future. Yeah, right, like we all believe them. Anyways, let's talk about what happened. First things first, let's get a clear picture of the financials. Altria's earnings per share, or EPS, came in at $1.15 for Q1 2024. This landed right on target with what analysts were expecting, so good news here. But on the revenue side, things were a little bit worse. 2.5% year-over-year decline to $5.58 billion. The drop was primarily driven by lower revenues in the smokable product segment, partially offset by higher revenue in the oral tobacco product segment and the all other category. Altria's bread and butter, the traditional smoking products, went down 2.2% year-over-year in sales. They declined 6.4% quarter-on-quarter, and it is obvious that Altria hiked up prices again to offset the decline in volume, a very familiar story to all tobacco investors in the past years. And apart from that, there are some other dark clouds on the horizon. The illicit e-vapor market is a growing concern for Altria. These unregulated vapes are a public health hazard and could potentially steal customers looking for alternatives to cigarettes. Altria is lobbying for stricter enforcement from the FDA to extinguish this threat. Now, let's shift gears and talk about Altria's attempt to overcome the traditional smoking segment's decline with their smoke-free products. Their main player here is NJOY, a heated tobacco product that heats up tobacco without burning it. Here is where things get interesting. NJOY's retail share in the US convenience store scene is growing. It grew by a solid 0.6 points in Q1, reaching 4.3%. This suggests more and more people are trying it out, potentially signaling a shift in consumer preferences. They shipped a boatload of NJOY consumables, think refills, and devices, indicating a growing user base. This is a positive sign for NJOY's long-term potential. Altria plans to submit applications for approval for flavored NJOY Ace products by the end of Q2. It will have age-gated Bluetooth technology, which I am very interested in seeing actually, because I have no idea how that will work. This could be a major green light for regulators, elevating Altria's good standing with them because it will make it harder for minors to use the devices. The success of these applications will be a major factor determining the future of NJOY. If the brand can navigate the regulatory hurdles and keep growing its user base, it could be a significant revenue stream for Altria in the years to come. Despite the mixed Q1 results, Altria reaffirmed their full year 2024 earnings guidance. They're expecting adjusted diluted EPS to be in the range of $5.05 to 5.17. This translates to a growth rate of between 2 and 4.5% compared to 2023. Even better, the midpoint of this range is actually higher than what analysts were predicting. So, Altria seems confident they can deliver strong financial performance throughout the year. This guidance suggests they have strategies in place to address potential challenges and capitalize on growth opportunities. They anticipate this growth to be more prominent in the second part of 2024. Here, it's important to note that future performance depends on many unpredictable variables, so this guidance should be viewed with an element of caution. As expected, analysts have mixed reactions to Altria's report. While some point out the revenue miss, others highlight the positive aspects like the reaffirmed guidance and NJOY's growing popularity. Here's a quick summary of their thoughts. The minor revenue miss isn't a disaster, but it's something to keep an eye on in future quarters. A consistent pattern of missing revenue targets could indicate underlying issues with the company. The reaffirmed guidance exceeding expectations shows confidence from Altria's management. This suggests they believe they have the strategies and resources in place to achieve their financial goals for the year. The CEO's comments regarding the lack of strong regulations suggest ongoing challenges, especially for NJOY's approval process. The regulatory environment surrounding smoke-free products is complex and constantly evolving, and Altria's success will depend on their ability to navigate it effectively. So, what does this all mean for Altria's future? The picture is not rosy, but not entirely bleak either. Their traditional tobacco business is stable for now, but faces threats like illicit e-vapor market and is dependent upon continuing price hikes, which no one knows how much longer will work. However, their smoke-free products, particularly NJOY, offer a potential path for future growth. The way I see it, Altria's success will depend on several things. First, get all the NJOY regulatory approvals and in general effectively compete in the ever-growing smoke-free market. Altria will need to develop strong marketing strategies and continue to innovate to stay ahead of the curve in that market. The oral tobacco market is getting crowded with a new player named Zen putting a dent in Altria's market share. Their long-reigning champion, Copenhagen, is still the leader, but is losing ground. Altria's attack plan seems to be to prioritize profitability within the category and push on their new modern oral tobacco product to compete with Zen. They believe the On brand is well positioned and has a pipeline of new products on the horizon. The success of On will depend on factors like branding, marketing, and consumer reception. Second, they have to mitigate the impact of declining cigarette volumes. While cigarette sales haven't fallen dramatically yet, it's a trend that, as I said, is likely to continue in the long run. Altria will need to find ways to offset these declines with growth in other areas of their business because they probably cannot rely on price hikes to offset the falling volume. Or perhaps they can. Who knows? They've been doing it for a long time. All right, let's turn our attention to something Altria is famous for: share repurchases. They recently sold a portion of their investment in another company and expanded their share repurchase program to $3.4 billion. This move signals their confidence in Altria's future cash flow and their commitment to deliver strong returns to investors. Share repurchases can increase the value of remaining shares by reducing the overall number of shares outstanding. So, what does this all mean for you? While I cannot tell you what to do with your hard-earned money, here are some things to consider based on Altria's Q1 report. Altria's core business and strong dividend could be appealing. But remember, the long-term decline of cigarettes is a lingering issue you cannot ignore. Investors seeking stability may find comfort in Altria's established brands and dividend, but should also be aware of the long-term challenges facing the traditional tobacco industry. The fact that a company is paying a growing dividend and has a nice share buyback program does not automatically make it a good investment. There are many other factors to consider, and if you want to know what they are, I talk about them at length in my Dividend Method program, which you can join by clicking the link in the description below. Altria's smoke-free products, particularly NJOY's potential, might be able to reverse the trend. However, regulatory hurdles and fierce competition remain obstacles. So let me know what you think about the recent earnings report in the comment section. And before you go, make sure to check this video that should have appeared on your screen to continue with your investing education. Always remember to read the disclaimer in the description of the video, and I will see you in the next one.